Thank you to Hardman Co for the opportunity to present 1PM. The first question that we get asked is, where does the name come from, 1PM? It stands for One Payment Monthly, which gives you a clue as to what we do. We lend money and then hopefully successfully get it back every month in terms of payments with interest. And we lend to companies in the predominantly in the SME sector. Without further ado, I'll get straight into the main topic, which is the investor proposition as we see it. Our shares are currently trading at less than 1 times net asset value and at a PE below the market sector. So I'm sure your eyes are drawn to the red exclamation mark there in the bottom right-hand corner of this slide. We believe the business is undervalued, and I think that's a stark inconsistency with the fundamentals of the business set out here. So let me quickly cover those on the slide. So reading across the top, we're experiencing strong demand for finance from UK SMEs, 83 million of business origination last year. We're dealing with over 16,000 SME customers now. We have a range of products to offer with asset finance, including vehicles, loans and commercial finance. Our credit risk is very well spread, a 90 million portfolio with no one receivable accounting for more than 0.5%. And we have a flexible business model of either lending on our own balance sheet or broking onto other lenders. Across the bottom, our funding lines are secure and substantial, and James will cover that in a moment. Our cost of borrowing is reducing, and we believe there are sound prospects for further growth in the SME sector. A number of leasing companies in the industry are reducing their prices and relaxing their credit criteria to chase growth quite aggressively. We're resolutely not going to do that. We believe there's enough growth in the market to be able to grow cautiously and steadily, and that's our approach. On top of that, however, we do believe that with the products that we have in the group now and with the various companies around the group, we can benefit from cross-selling opportunities. So all of those things, I believe, are inconsistent with the current value of our shares. So hopefully by the end of the presentation, you'll agree. On top of all of that, we are proposing a dividend. We see ourselves as a growth stock, but a steady growth stock rather than income stock. Having said that, I think it's appropriate to reward our shareholders with a modest dividend. That's at 0.5 per share this year, which is the same pence per share as last year, but on the basis that we issued some shares in a placing just after the year end, it actually represents a 60% increase in the absolute amount of dividend that we're paying out. And our policy is to increase our dividend going forward. If we just dwell on the SME market briefly, I'm not proposing to go through all these bullet points, leave them to read them at your leisure. I think the key points to note are that the challenge for all SMEs is simply cash flow. They need day-to-day cash flow to finance their businesses. In some ways, they don't mind whether it's leasing or loans or invoice finance, and we can help tailor the products that they need accordingly. But the challenge is to generate cash. The banks are not geared up to lend to the smaller end of the SME sector in the way that they used to be. And borrowers, SMEs, are therefore coming to alternative finance providers like ourselves. The keys are to offer a flexible service, speed of turnaround and a tailored approach, and we pride ourselves on average 13 days from proposal to payout. And without being disrespectful to the banks, it will probably take 13 days to get your first appointment to go and see them. So we believe that speed of turnaround is important, and as I said, there's an opportunity for increasing our market share. This gives you the shape and size of the group as it currently stands. We're organised into 3 business divisions. So the track record has been in leasing. 1PM Finance is the original company in the group, which engages in lending to predominantly high street businesses that have proved to be very resilient through various economic cycles. We acquired Academy Leasing, which is a business in the north of England that is a broker and a funder, introducing the funding and broking element to our model. And Bradgate provides hard asset financing. The difference between hard asset financing and soft asset financing is this. Hard assets tend to be assets that there is a strong residual value for at the end of 3 years of use, for example. Soft assets are those assets where there's not much of a value after the 3 years of use, and therefore the lending model is all about the affordability of the company to repay and taking personal guarantees as security from the proprietors of the business. In addition to our leasing business, we have the loans division in the middle. Again, 1PM Finance, the original company in the group, provides business loans. That's lending on our own balance sheet, and those tend to be loans for working capital purposes. That's lent on our own balance sheet. We've complemented that balance sheet lending with generating commission income from a company called Intelligent Finance, which we acquired just before year end. And Intelligent Finance does second charge bridging and commercial finance for property. So that lending is all property backed. So in the loans division, we're replicating the funding and broking model by funding loans on our own balance sheet at 1PM and generating commission through intelligent loans. And subsequent to the year end, we've added the third division, which is the commercial finance division, through the acquisition of Generate Finance, based in Abingdon in the south of the UK, and Positive Cash Flow Finance, based in Manchester in the north. And the UK invoice financing and discounting market is very much a north-south divide. It tends to be two separate markets. So we've established a national presence by acquiring both those two companies. So 152 employees, 7 sites. After year end, now lending 120 million to around 16,000 SMEs. Just to bring that to life a bit further, if I may, just to explain a little more about what we do. So we're arranging or providing business critical finance to smaller SMEs, lending from £1,000, as little as £1,000 for a piece of capital equipment, all the way up to an invoicing financing facility, which could be £500,000. It can be as short as 3 months or as long as 60 months. We have a pair of eyes on every deal. We'll never go to fully computerized underwriting. And in the case of the hard assets, which actually go out in a site visit and literally kick the tyres of the asset. We're very much focused on adhering to strict underwriting and credit control policies, as I mentioned, taking personal guarantees on all the business we do. I think what's interesting here is that we're typically dealing with owner-managers, and often they are a lower credit risk than the underlying numbers in their business would suggest. And that leads to a very low write-off rate of around 1% of our total portfolio, and James will cover that shortly. We're providing our business at around 17%. That's our blended interest rate cost, borrowing around 5.3. So you can see there is a substantial net interest margin that we're able to deliver. And just some examples on the right-hand side of the slide. I'm sure you've had a chance to look at that already, but in terms of the complexion of our high street lending, it's very much what I would call staple diet businesses. So we all go out and get our cars MOT'd and get our hair cut and buy our coffees from Starbucks and our sandwiches from Subways. Those are the kind of businesses that we're lending to on a day-to-day basis. At Academy Leasing, they tend to do slightly larger deals, and as I mentioned, they have the opportunity to not only lend on their own balance sheet, but to broker onto other funders, so they can do larger deals. And there's a couple of examples here: Crystal Palace Football Club and Lancashire County Cricket Club, where the amount of the borrowing has been far too big for our appetite, but we've been able to take the deals and broker them onto the likes of Investec and Macquarie and others. And then hard asset funding, you won't know Jaw Services Limited, but they have contracts with companies like Lafarge, and in this particular example, it's the £345,000 stone crusher where we've taken a commission for arranging that finance. So hopefully that's helpful for you to be able to see the kind of business we're doing. The important thing when lending to companies in the SME space at our level is to ensure there's a very wide spread across many sectors. Here are the top 10 sectors on this pie chart. The lowest there, number 10, is already less than 2%. So you can see that there is a long tail of many SIC codes that we lend to. And as I mentioned, typically these are very resilient sectors. And in the largest sector there, sort of 6.17%, unlicensed restaurants and cafes, there'll literally be hundreds of deals in that particular segment. So the average lease for this kind of business is around £9,000 per year, lent over 3 years, and as I say, at an interest rate of around 17%. So relatively high-risk business in some respects, and the way you mitigate that risk is to make sure it's spread over many, many different sectors, and that each individual deal is not significantly high value. We're not the only people that are in this space. There are some competitors, and I'll come on to that in a moment, but just a quick word on business origination. As I mentioned, we generated £83 million worth of business last year. On a like-for-like basis, year on year, that's 23% organic growth. We're very pleased with that level of growth. 48% of that we wrote on our own book, and the rest we broked on. And as you can see in the table there, that includes 16.6 million of vehicles finance. We don't put any vehicles on our own balance sheet. We don't particularly like the residual risk in vehicles. Other companies do it very well. We're happy to arrange the finance, but we broke it all on. And the only other point I would make on this slide is you'll see that the 1PM origination, the original company in the group, that declined a little from 2016 to 2017. That's because we deliberately took our foot off the gas in terms of writing unsecured loans, as we call it, the loans that are for working capital purposes and not backed by an asset. And I think that's the right thing to do to ensure that that is kept at a relatively low element of the overall portfolio. So moving on to the competition point, as I mentioned, I won't go through this slide in detail, but needless to say that we compete at times with the banks all the way down to what we call bedroom brokers, one or two finance brokers that will finance a couple of deals on their own balance sheet. The important point here is the table at the bottom. As an alternative finance provider, we need to be flexible in our approach. Speed of service is important, and it's a personal, tailored approach. And now adding to that the range of financial products that we're able to offer, leasing, loans, commercial finance, we believe we have a competitive advantage over other players in the market. And that competitive positioning all fits into our overall strategic plan. We have an aim to become a 100 million market cap company. That's always been the case since we put this plan in place a couple of years ago. And the objectives that will get us there are set out on this page. Building scale through distributed separate entities is what we've done in acquiring the business that we've acquired. We have multi-channel and multi-product offering now, and we're maintaining that risk mitigation, as I mentioned, through funding and broking. We will always adhere to the strict underwriting credit control procedures and aim to be appropriately geared with cost-effective funding, which again James will mention in a minute. And we've got a project going on now around becoming more digitally capable. So this chart has been in place for a couple of years. The change this year is the fourth green tick. We've now introduced the adjacent products. And what we're saying to shareholders is that provided we deliver our numbers for this financial year and next financial year, and provided we get a bit of a re-rating in the PE multiple for the stock, we'll be able to get to our 100 million market cap without going out to our shareholders to raise significant amounts of more money. So that's a very quick canter through the sort of shape and size of the business and what we do. I'll just hand over to James to cover the financials.
Just some highlights of the numbers we released last week to the city. It's some numbers we're quite proud of. Our revenue's gone up 35% to 16.9 million. Our profit before tax and exceptionals up 17% to 4.3 million. Those are the two headline numbers that we went out to the market with, and we were very pleased in the current economic conditions to hit them and marginally exceed them. Pleasingly though, sort of every one of the key KPIs that we look at internally has also got a green tick next to it. We can see our net interest margin, which is the difference between the cost of funds we can get money at and the cost of funds we lend on to our clients, has gone up to 12.3%. EPS is up to just under 6.1. And our deal origination, as Ian spoke about, which is a key thing for us, it's the future PBT, 6, 12, 18 months down the line, has increased to 83 million. The flexibility of the model means we can decide whether to take that and write it on our own book, or we can broker it on. So we can improve our cash flow if we need to, or our short-term profitability, or we can extend it for the longer term. It's quite a unique model and quite flexible. And last year we saw 30% growth in the business that we wrote on our own book. So again, very pleasing. And we can only do all of this if our funding partners shared the vision of what we're doing, and they all have provided excellent facilities, continued facilities, and we've got a lot of headroom in our funding facilities going forward. So at a very high level, all our financial metrics went in the right direction, which was great. There's a lot of figures coming up next, and what I'll probably do is just draw out one or two key points on them because of the timing. We're looking at revenue. The key point is the sort of right-hand corner. The growth in revenue from 12.5 to 16.9 is slightly disingenuous because there were two acquisitions in that year, so it's not quite apples with apples. I've pro-rated the acquisitions on the right-hand column as though they were there for that year, so we can see our actual organic growth is 13% on a like-for-like basis. We're quite pleased with that because obviously when you're on a buy and build strategy, you can take your eye off the ball and you focus on the sexy acquisitions and not maybe what you've got back home. And we're very pleased to see that the entities we've got in the group that have been with us for more than a year are all growing organically, which is great. Similarly, by product, the leases and the loans have grown, and commercial income, which is our broked-on income, has also gone up as well on an organic like-for-like basis. So revenue, however you sort of cut it and dice it, is very pleasing for us. Profit before tax, just very quickly on that, again, same point. All the three entities have grown their profit before tax in the last year, which is great. And at the same time, we're able to increase our head office. So we're investing in finance, HR, compliance, and IT as we sort of grow up as a group. And we've been able to do that and still hit our numbers, and we will continue to do that. Just some other very quick points. We've seen our interest rates have held up, and that's quite a key thing. So the range we offer is between 9 and 28%. On average, the lease is about 16 or 17%, and a loan slightly more, 17 or 18%, giving us a blended charge of about 17.5%. Well, there is increased competition. We're seeing those rates being able to hold up, primarily, we believe, because of the better service, the speed of customer service, etc. we think we offer, and we think people are willing to pay a slight premium to get that, and it's being borne out in the deal origination numbers, as Ian alluded to earlier. The portfolio, the key point on this, again, sorry, there's quite a bit of information on there, but the key point of the third and fourth bullet points, we've seen the net debt write-off of about 1% of our portfolio, so it implies all the companies we're buying into the group have a similar write-off level to the group. We've seen that maintained over the last couple of years, and despite that, we're able to increase our bad debt provision, so it went from 1.3% of the book to 1.6% last year. Our plan is to try and drive that up to about 2%. There's nothing in our data sets saying we're seeing a downturn, but just in case there's a rainy day, we're always looking to increase that bad debt provision, so we're moving it towards 2%. And finally, quite a key one, as I mentioned, funding. We're only able to do what we do because of the funding that sits behind us. Growing up as a group, we've sort of managed to harmonise everything, set up a central treasury function. Leases are funded by block funding. We did have about 12, which was 12 sets of audits, 12 sets of admin. It was a bit of a nightmare. We've harmonised that down to a handful of 5 or 6 key providers with facilities between £7.5 and £20 million each. We're not going to shrink that any further, because if any funders ever did pull out of the market, that's a potential risk. So we always keep significant headroom in there. So if 2 or 3 did ever move out of the market, such as Lombard did a few months back, we've got headroom to just switch our funding across, and we'll continue to do that. We established a secured loan note programme this year for high net worth individuals through a boutique corporate finance house, and that gives us access to fund money for the loans. That tends to be around the 7% mark. It's a bit more expensive, but it's a lot more flexible. And post year end, as Ian touched on, we've bought 2 invoice finance firms, Generate and Positive. They're funded by back-to-back facilities with Lloyds and RBS, 12 million and 25 million respectively. Due to the nature of invoice finance, it's a slightly cheaper cost of capital, and that's about 3.5%. So we've seen the funding facilities keep pace with the business. We've got headroom now for the next 2 years' worth of growth, and the rates continue to come down, and we think that will continue in the near future. And back to Ian for the summary and outlook.
So we're delighted to have been able to deliver the results that were expected of us for the last financial year. Equally delighted that the strategic plan that we've implemented is beginning to deliver results. All the companies that we've acquired are performing either to plan or better than plan. We're now organised into the 3 product divisions with dedicated leadership, and what that's led to is a switch now from what we characterise as the first half, which was all about the buy and build strategy, to winning the second half, which is all about delivering the numbers that are now required of us. And the expectations from our broker is that we'll do just under 30 million of revenue in this financial year and 7.8 million of pre-tax profit. And that's just an aggregation of all the different companies' budgets for the companies that we've acquired. So we're very much focused now on delivering those numbers through group-wide projects, improving the net interest margin, ensuring that we cross-sell across the group, and improve our digital capability. Very pleased to report that the first quarter of this financial year is in line with those expectations, and that gives us confidence going forward. And that's what underpins our confidence in proposing the dividend for the year. So going back to where I started, to finish on the fact that I think we are an attractive proposition at this point, and hopefully you'll agree. Thank you for listening, and we're happy to take some questions.
I guess one of the major dangers of buy and build is that you overpay. And I don't know this company very well, so I'll look at the numbers because they look pretty good generally. But the fact that you've only held your dividend, which you're saying is a positive because you're paying more, I think suggests to me that you're a bit worried about cash and you may have overpaid somewhat. So you're looking to future years?
No, not at all, no. I think just in terms of the acquisition point, we're very comfortable with what we paid for the companies that we've bought. It works out on average at around 6 times earnings if we pay out the full amount of consideration, and that's based on some earn-outs. So those earn-outs have got to be delivered, and some of them are pretty stretching targets. In relation to the dividend point, it's a progressive policy, as I mentioned, and we'll continue to follow that policy. We have some shareholders who say to us, why are you paying a dividend at all? You can earn a lot more money by using the cash for lending, for leasing and loans. And we have other shareholders who wouldn't be on the register unless we pay a dividend. So it's just finding that right balance. And I think it is important for us to continue to pay a dividend, but at the level that we're paying it, albeit quite modest, it is a big increase on last year's absolute amount of money.
Can you tell us a little bit about the LTIP that's in place?
Yes, I can. So we've put an LTIP in place, which is based on conditional share options being offered. There are two performance conditions that have to be met. One is a service condition. So the executive team and the senior management team who are going to potentially benefit from the options have to be employed for the next 3 years. We've only just announced it, so it is 3 years to go. And the market-based performance condition is based on share price. So at 60 pence or less, none of the LTIP shares would vest. At 110 pence or more, all of them would vest. And clearly the ideal situation is a linear progression from 60p to 110p.
And if you hit that 110p and they all vest, the value of the shares that's awarded to management is equivalent to how many years' profits?
Gosh, so if it was let's say we achieved a £100 million target, it would be about £7.5 million. So in terms of annual profits based on this year's numbers, it would be 1 year's profits pre-tax.
Okay, I haven't looked at your figures in detail. I think you've had several fundraisings, haven't you, placings. Were any of these open to private investors, or are they all institutional? And what follows on from that, I mean, from just glancing through the figures, seems like although your top line is increasing very fast, I mean, your gross profits are going up by double-digit figures, but your underlying earnings per share is not progressing that fast. I mean, that suggests the effect of a lot of shares being issued, and I'm just wondering how long this is going to go on. You know, to what extent are you going to continue with more placings, and how would this affect me as a private investor?
Yeah, that's very, very fair observations and questions. The very first placing that was done was around 4 years ago, well before our time. It was 1.5 million that was just done straight to one institution. When I got involved in the business, we changed that. So there have been 3 placings since, all of which there's been an open offer element of that to make sure that we're not only raising money from the institutions, but also looking after the individual shareholders. The last 2 placings have been to raise money for acquisitions, and therefore there has been an increase in the number of shares, and the revenue and the profits from those businesses that we've acquired have still got to come through. So the earnings per share increase should flow through later as we progress and those companies deliver their earnouts. We've now completed the buy and build strategy. I think we've got the 3 legs of the stool in place: leasing, loans, commercial finance. We're not proposing to go out and do any more placings and dilute shareholders further. We believe we can get to the 100 million market cap without having to do that, and that's why the LTIP is also geared on the same principle. So I think we're all aligned on that point. So there aren't any plans to raise more money through equity fundraisings.
Presumably you continue with some bolt-on acquisitions, though, would you?
Yeah, I mean, I think we will. I think there is the opportunity to acquire small businesses out of cash and debt if we feel there's an opportunity to do so. There's no particular products that we want to add to the product range, but there may be some infill acquisitions of leasing books or small brokerages that we might want to acquire. But the time and attention of the management team needs to be now on delivering the numbers, not being distracted by further acquisitions of any size.
Yes, you're showing a very attractive net interest margin based on a borrowing rate of 5.3%. What's the risk to that as the interest rates start to increase? What are the source of your funding sources?
I do that one. So the way the funding is in place is existing funding is matched over the life of the lease. So for the leases we've done to date, if there was an increase in rates, all the leases the funding we've got in place stays as is for the life of the lease and drops out over the next 3 years. So the question would be, okay, we need to go back to our funders and get more funding. What do we do there? And theoretically, they add 0.25% on or 0.5% or something like that. That is a risk that could happen. What we've done in the past and what we would expect to happen again is that increased cost has always been passed on to the front end, to the end user, and we've never seen a dip in take up on that. So we would expect that to happen. That's what our competitors do, and we'd expect that to happen. However, in the background, we are in discussions with other facilities as well to get fixed 5-year money as well that would sit alongside it, that would take that issue away if it were to arise. But we're very confident from what we've done in the past that if there was an increase of, say, 0.25%, 0.5%, that would be able to be passed on to the end user.
Okay, thank you very much.
Thank you.